So this topic is one of the topics that's mostly will come in your main exam as well. Yes, this is one of the topics that will, the exams is theory and practicals. Okay, I think 80% is going to be of practicals, then 20% theory, or maybe 15% theory, or maybe 10%. And control account is one of the topics that will come or mostly come as a theory, question. Okay. One of the topics that mostly come as theory is control account. So we should that's a control account. No, we are talking about the accounting concept. Sorry. We're talking about the accounting concepts. Control account is actually practical. So I'm talking about this topic, accounting concepts. Sorry about that. It's one of the theory topics that will be added to your practical questions. Okay. So kindly pay attention to. But for the sake of the IE, kindly pay attention to some of these things. The conceptual framework. Yeah, the conceptual framework is actually there's no much question that will be coming from it in the exams or maybe I or anything. Okay, there's no much questions that will be coming from it in the that maybe you will see only one question or maybe one or two questions. Okay, but the main focus is going to be on the accounting concept, even the characteristics of accounting information. Already we know what accounting information is. We discussed that that was Monday. We discussed accounting information, that was Monday, which we look at accounting information users as well. Okay. Now, this topic as well, or this one, qualitative characteristics, is also a common theory topic that is likely to come in your exams. Okay. So you can be asked to explain the qualitative characteristics of accounting information. So there are so many, okay? There are so many. Other books will give you more than 4. Other books will give you like 6 or 7. But there are 4 major. We have relevance, we have reliability, we have comparability, and we have understandability. These are the 4 major qualitative characteristics of accounting. Yes, Madam Margaret.
Please, I want to know if you are sharing your screen.
Yes, I'm sharing my screen.
But it seems like okay, then I have to go and come back. All right, thank you.
Hello, class. Can you see my screen?
Yes,
Yes, we
yes,
can.
Yes, sir.
See your
All right.
screen.
That's where we can see.
yes.
We can see.
All right. So these
Oh,
are
I
the
can.
4 major. These are the 4 major characteristics of accounting information. Okay. So the first one we are going to look at is relevance. When we say relevant, or when we say that information is relevant, okay, don't forget, our focus is on accounting information. Okay. Now, when we say accounting information is relevant, what it means is that it can influence what decision making. Okay. When something is relevant, it means that the thing can influence what decision making. So accounting information is relevant. One, it influences what decision making. How does accounting information influence decision making? Most of the time, accounting information are quantified in what? Monetary value. Okay. They are quantified in what? Monetary value. For example, you have an accounting information that, let's say year one. Let's say you have information that year one. Okay, let's look at this. Let's look at it this way. So let's say your business, let's say your business is, let's say, KT Limited. Okay. Let's say your business is KT Limited. Now, KT Limited The business has 3 different departments. Now, the first department deals in what? Let's say shoes. This in shoes. The second department deals in, let's say, bags. And the third department deals in, let's say, pharmaceuticals. Okay. Now, this KT Limited has these 3 departments. This is the business's name, and the business has these 3 departments. Okay. There is a shoe department, there is bags department, and there is pharmaceutical department. Okay. Now, the pharmaceutical department makes more money, makes more profit than, let's say, these 2. So assuming the pharmaceutical company makes a profit of ratio, let's say 3, this makes a profit of ratio, which is 2. Let's say this makes a profit of ratio, let's say 1. Okay. Now, if you are this business owner, okay, if you are this business owner and the accounting department for the accountant for pharmaceutical department is telling you that, okay, we are making this, the bank's accountant is telling that we are making this, and the shoe department is telling you we are making this. If you are a business owner, this information, what will you do with this information? Yes, anybody? What do you think you can do with this information? Anybody?
It will help you to know where to invest more.
Clap for him. Clap for the boy. Clap for the boy. Clap for the boy. Very good. It will help you to know where to invest more. Okay, it will help you to know where to invest more. It will help you to know which department is performing better. It will help you to know which department management is performing better. Okay, it will help you to know which department to put much resource into. Okay, so this small accounting information is helping to make decision. It happens to influence decision. Now let's look at this company. Do you know that who knows about this company, Traction? I don't know if I'm right, but who knows about Traction? I don't know if that is the name of the company, but who knows about Traction? They produces Samsung. I'm sure they produce a Techno, Itel, and Infinix or so. Is it Traction?
No, it's
Hello?
Transsion.
Is what? Is the name of the company Traction or Transsion?
Transsion.
Okay, very good. Now, not a lot of people knows that Transsion, that company produces Techno, Samsung, and Infinix. Okay, so it's just like let's say this company produces what? Techno produces Infinix and what? Itel, and out of them, no, one is performing better. Okay, so when we say accounting information is relevant, it simply means one is that it influences what? Decision making. Okay, another one is about it is timely. It is timely. Okay, it is what? It is timely. It is on time. It is prepared on time. Okay, it has a confirmatory value. When something is relevant, you can use it to confirm. It has a confirmatory value. You can use it to confirm the truth. Okay, and also has what? A predictive value. So take note that the first qualitative characteristic of accounting that we discuss now is relevance. And when it is relevant, it talks about these 4. Okay, very good. The next one is reliability. The next one is what? Reliability. When they say something is reliable, when they say something is what? Is reliable, it means what? The thing is complete. You can't say something is reliable and the thing is not complete. No, that is not it. When we say something is reliable, it means that the thing is complete. Okay, it is what? It is complete. It has what? A faithful representation, meaning there is no bias. There is no what? Bias. It has what? A faithful what? Representation. It is what? Neutral. It doesn't take sides. It is neutral. It is prudence. Okay, it is neutral. It is what? Prudence. So please kindly take note of that. We look at relevance, we look at reliable. When the thing is reliable, it means what? It is here. When we say a human is reliable, if you are somebody who is reliable, meaning that what? You are complete. If you are not reliable, you are not complete, you are incomplete, you are improper fraction. Okay, so accounting information, one characteristic is it is what? Reliable, and this is what it means. Comparability. Accounting information should be what? Comparable. Okay, similarities and differences can be discerned and evaluated. Consistency and what? Disclosure of accounting policy. Now, what this is simply talking about is that accounting information should be comparable. Let's say, for example, let's say year one, okay? Let's say year one, you make a profit of 10,000 cedis. Okay, year one, you make a profit of 10,000 cedis. Year two, you made a profit of 12,000 cedis. Year three, you made a profit of, let's say, 8,000 cedis. Year four, you made a profit of, let's say, 15,000 cedis. Now, year one, you made this profit. Year two, you made this profit. Now, you can actually compare these two to know which part is performing very well. Now, you made a profit of 12,000, then now you drop to 8,000. Now, this can help you to compare some differences or similarities to know where you've gone wrong, where they need to be put, they need to be what? Much attention. Okay, so basically, when we say that, well, accounting information is comparable, or they have this ability of comparability, it means that what you can actually compare what differences and what similarity is what consistent. Okay, you can compare the thing with other things. It means what it is consistent. Okay, and also understandability. Okay, understandability. Accounting concept, one characteristic is that what it explains what complex matters. You know, to accountants, let's say accountants, if you're somebody who do not have any accounting idea, and you hear the word accrued, assuming that you are not an accountant and you hear the word accrued, you hear the word you hear what let's say salaries accrued or outstanding salaries accrued, you might not really know what they are talking about, but if they are to explain it to you, then you know that okay, this is what this accounting person is trying to communicate. If you are not an accounting person, you've been given what if you're not an accounting person, you've been given what, let's say, a statement of financial position for you to analyze it. You can't analyze it because to you it is complex. But if it should be broken down for you, then you understand, okay, we are able to make this profit. This is the net profit. Okay, our debtors so and so, our creditors so and so. Okay, so what you need to know here is that accounting concepts, we have four, and these are their explanations: relevance, reliability, comparability, and understandability. Okay, now this also, the generally accepted accounting principle, the GAAP, is actually one of the things that normally comes in IA. Okay, is one of the things that normally comes in IA, the GAAP, or the value. So what the lecturer will do is that you see this GAAP, the full meaning is generally accepted accounting principle. So the lecturer may write general accepted accounting principle or generally accepting accounting principle. So the lecturer will try to write it in different ways but take note that it is generally accepted accounting principles. Generally accepted accounting principles. Please kindly take note of that. Okay, the term used to describe how financial statements are prepared in a given environment. Or another IA question is that they can say that, so the lecturer may write, let's say question 5. The term used to describe how financial statements are prepared in a given environment is A, GAAP, B, IFRS, C, IAS, C, so and so. We have so many, bodies. We have the IAS, we have the IAS, we have the IFRS, we have the IFRS, we have the GAAP as well. We have other bodies. Okay, I think we should be here. Let's see. Okay, yes. I think we have the IFRS, we have the IAS, we have the IPSAS, there are so many of them. Okay, we have so many of them. Mostly in Ghana, we use the IFRS and the IAS. Okay, commonly we use the IFRS and the IAS. So please, these are 2 IA questions that you can actually get from here. And I think Monday, we actually saw a question on the GAAP. Who remembered? I read an IA question to you guys on the GAAP. Who remembered? Hey, nobody here remembered. We saw an IA question on GAAP. All right. By the way, am I audible?
Yes,
So
sir.
you're audible.
Yes, sir.
All right.
Please.
All right. So please, this is it. Okay. This is it for GAAP. So you can see 2 IA questions. Okay. The lecturer will write the GAAP, let's say the full meaning in 4 different ways. Then you have to pick the best one or the correct one. Okay, so it is generally accepted accounting principle. It is not general accepted accounting principle, or it is not generally accepting accounting principle. The lecturer will try to confuse you. Okay, but if you know your stand, you know your stand. Okay, if you know where you stand, you know where you stand. All right. Now, our main focus tonight is on the accounting concepts and principles. Our main focus is on the accounting concepts and principles. Accounting concepts and principles. Now, when we say accounting concepts, okay, when we say accounting concepts.
Hello, sir.
Yeah, hello.
Please, are you sharing a slide?
Yeah, I'm sharing my screen.
But then maybe
But please, we can't see your screen.
I can't see your screen.
Please, I can see.
We can see. So just log out.
The screen is showing. The screen is showing. Then maybe it's your
Try to
network.
view your
We
network.
can see.
If you can
Your
reconnect.
network. Check your network.
It is
You
showing.
guys should leave and come
I
back.
can see.
All right. Thank you very much. So when we say accounting concepts, yes, accounting concept. Now, the key thing you need to know here is that what they are broad assumptions. Don't forget that. Don't forget that. They are they are assumptions. They are broad assumptions. Please, this is something you shouldn't forget. Okay, don't forget that they are broad assumptions. Okay, they are broad assumptions which underlines the preparation of periodic financial accounts of business enterprises. Okay, so please take note that or simply when we say that accounting concept, they are just assumptions in preparing of final accounts. Okay, now accounting principles, they are general decision rules derived from the objectives and the theoretical concept of accounting that govern the development of accounting techniques, plain grammar. But what is simply talking about is rules and regulations. Okay, when we talk about principle is about our rules and regulation that govern something. Okay, so the rules and regulation that governs what accounting techniques, that is accounting principle. Okay, now let's look at let's look at accounting, concepts. Okay, let's look at the accounting concept. Now, the first concept we are going to look at is the going concern concept. The going concern concept. Okay, now, what is a going concern concept? Going concern concepts is an assumption, or it's something that a business is assumed to continue operating for the foreseeable future. Okay, so when a business is assumed, don't forget, accounting concepts are what? Are assumptions, broad assumptions. Okay, so the assumption that a business should continue for the foreseeable future is what we term a going concern concept. Okay, the assumption that a business will continue operating for the foreseeable future is what we term going concern concept. Now, let me ask a general question to everybody. Let's say you set up a business or you open a new venture. Are you expecting that the business should collapse within 1 year, or the business should still be operating for foreseeable future? Yes.
It should still be operating.
It
Yes.
should collapse. Yeah.
Your business should collapse in a few years. Who said?
Like seriously?
Who said?
That's the
who
devil's
said,
advocate.
Oh no, let's hear. Who said you want your business to collapse in 1 year? Who said that? Let's hear a reason. Why do you think your business should collapse in 1 year?
So I'm sure he didn't get what you said. That's why.
Oh, okay. So I'm not sure anybody here who want to set up a business and who assume that. Don't forget, it is about assumption. Okay. I'm not sure that anybody here will set up a business and assume that, oh, the business should collapse, or maybe the business should not stand the test of time. The business should collapse within 1 year. I'm not sure anybody is here like that. Everybody is having with that kind of foresight. You want the business to you're even dreaming that the business should even expand. Something small that you started, your dream is for it to expand, not to collapse or not to stop on the way, right? Very good. That is what we term the going concern concept. Please, is that clear?
Yes, please.
Sir, please say it again, the definition.
So a business will continue in operational existence for the foreseeable future. Okay, it will be in existence for long. Okay, that is what you need to know about what going concern concept. Okay, very good. Now let's move to the next one. The next concept is accrual concept, or some people can say matching concept. Okay, so now when we say accrual concepts talks about two different things. Okay, accrual concept is actually about two different things. It's about income and what expenses. Now, this is what accrual concept is saying. Now, accrual concept is that you should record income when earned. Okay, you should record income and expenses when they are earned, or when they occur. Okay, so take note. Accrual is saying that record income when it's earned and expenses when they are incurred. Okay, not when cash is actually what received or paid. This is what we are saying. Okay, accrual concept is saying that as a business person, you should record that you've made a sales when let's say when you do the thing, or maybe when you provide the good. not when cash is given. Okay, so record when it is earned, not necessarily when cash is paid. For example, you go to a restaurant. Okay, now let me ask you a question. Do you pay before eating in a restaurant or you eat before paying? Yes. Do they provide the service
You eat
before
before
you pay?
paying.
Do they provide the
You
service
eat.
before you pay or you pay before the service?
You eat first.
Sometimes
You
sometimes you
eat
pay
before you
sometimes you pay before you
pay.
eat.
Okay, but generally,
You eat before
generally,
you pay.
generally you eat before you pay when they bring what the
Yes.
bill. Now, this is a clear
Sure.
example of what we are looking at. Okay. Now, the accrual concept is saying that you the one eating or you the one in the restaurant, you should record or you should know that you made an expense. Not when you make the payment. At the point where you are enjoying the service, you should know that you've made the expense. The people or the restaurants should also record that they've made an income, even though they've not received the money yet. So you too, you should know that you've made an expense, even though you've not made the payment yet, and the restaurant also will know that or will record that, okay, we've made an income, even though we've not received the money yet. That is what we term what the accrual concept. I'll say it again. You should record income when it is earned and expenses when they are incurred, not when cash is actually given or received. Are we on the same level?
Yes, please.
No, sir. Please come again.
Come again with which one? Which one, please?
The accrual concept.
If I should come again, I have to use the local language because I'm not sure there is any other way I could explain in English that I have not. Who doesn't understand? Who is confused? Who doesn't understand what we are doing?
Sir, please let me explain to her.
Okay, sure.
Okay.
Sir, you
Oh,
said
please.
accrual.
Oh, whose
Hey,
generator
which
is
one is
that?
that? Please, you said accrual concept says that you should record income when they are earned and record expenses when they are incurred, not not actually in cash. And
Exactly. Exactly. That simple as that. Simple as that. So let's look at something. Let's look at something. Assuming that you go to, let's say you register to attend a school, okay? Assume that you registered to attend a school, then you've made the payment. Assuming you've made, let's say you've paid your school fees, let's say the 4,000 cedis, okay, maybe for the year or a semester, and you've not attend lectures all the times, okay? Will you try to demand for let's say, will you try to demand for maybe a refund for the ones you've not attended? Will you try to do that?
No, sir.
It will
Very good.
depend. The term
Okay,
of
it will depend how.
paying your fee.
Monies paid are not refundable.
No, see, so are you trying to say that you are in school is in section, then you decide not to come to school, or it is true you that you didn't come to school, or not that the school decided that so and so, it is you that don't want to come to school, or you didn't come to school for some time, then you want to demand for refund because I mean you are like how? I don't get it. It is not possible. Okay, the money you paid, even if you pay the 4,000, and let's say you want to come to schooling once out of the 100 times you're supposed to be in school, or maybe the 90 times you're supposed to be in school, you come to only to school once, you cannot get a refund. Okay, you cannot get a refund unless you are paying on what? On a daily basis. Then if you don't come, you don't pay. You get it. But so far as it is something in bulk, school is in section, you decide not to be attending, you can demand for a refund. Or you can say that, okay, let's say this year I'll not be attending school for I'll not be attending school for the whole of the semester. So I'll not pay the whole 4,000. I will only pay 2,500. That is not possible. Okay, that is not possible. So please, I hope the accrual or the matching concept is understandable. I hope we all get the concept.
Yes, we get
Yes,
it.
sir.
All right. That is for the accrual concept. Now let's move to the next one, which is what? Business entity concept. Business entity concept. Now, this concept is saying that the business is treated as a complete separate from its owners. Okay. Okay. So simply, business entity concept is just an assumption that the business should be a separate entity from its owners. Okay. The business should be a separate entity from its owners. That is why, let's say, the personal expenses of the owner of the business are not supposed to be mixed with the business's expenses. Those of you that you have business, then your personal expenses, you mix it with the business expenses, you are not doing a good job, or you are not running your business very well. Okay, you are not running your business very well. Your personal expenses are not supposed to be mixed with the business's expenses. So when you take from the business, then that is drawings. Okay, so we have two types of drawings or forms of drawing. We have goods drawings and we have what? Let's say cash drawing. For example, let's say you own a pharmaceutical business. Okay, if you take drugs or if you take a product from the business for your personal use, then that is what we call what? Goods drawing. Okay, now you take money from the business for your personal use. That is what we call what? Cash drawings. Okay, that is what we term what? Cash drawings. These are some of the things you need to know so that you can actually prepare your financial statements very well, because you'll be given you'll be given listing you'll be given a trial balance with all these things, drawings and co, which you have to know where to record these values. Even next semester, when you start doing partnership accounts, yes, partnership accounts, goods drawing from each partners or partners drawings and other, you have to know where to record them. So please kindly know that entity concept is simply about a business which is separate, or a business should be what? Separate from its owners. That is why, let's say, when someone sue a business, the person is not suing the owner of the business, but rather the person is suing the business. I don't know if you understand what I'm saying.
Yes, sir. I understand, sir.
Let's say you go to maybe which this let's say you go to maybe GCB Bank. Okay, let's say you go to GCB Bank and you enter the hall and then start, let me be mistakenly or accidentally you trip and fell, or because the floor is slippery or you fell, then you got your arm broken. You cannot sue the shareholders of the business. You can only sue the business, because the owners of the business, which are the shareholders, are different from they are different from the business. So you cannot go and be suing them individually. You don't even know the people who own shares in GCB or the owners of GCB. Okay, so that is what we are saying, that the business entity concept is simply that the business should be what? A separate entity from its owners. Hence, the expenses of the business should not be mixed with what? The personal expenses of the owner. Okay, very good. Now we have the money measurement concept. Another concept that we are going to look at is the what? The money measurement concept. Now, this concept is simply about you should only record things that can be measured in money. Okay, You should only record things that are measured in what? In money. Please, accounting is not about sentiment. Accounting is not about feelings. Non-monetary items should not be what? Recorded. Example, loyalty. Loyalty cannot be what? Quantified in monetary terms. Let's say the brand reputation, the business's reputation, you cannot quantify it, or you cannot put money value on it. Or the skill, the skill the manager possesses, you cannot put, you cannot record that because they don't have what? Monetary value. Okay, those things are important, even though they are important, right? But you cannot reliably quantify them. You cannot reliably quantify them. So the money measurement concept is saying that you should only record things that can be what? Measured in money. Things that can be measured in sika, kudi, laja, ega. Okay, only record things that can be quantified in a monetary value. Example, cities, naira, dollars, Kuwait, pounds, euro. So that is why you realize that all the questions you are solving, you are only seeing what? Currencies. You are not seeing feelings. Let's say they said that what? Income, 15 feelings. Let's say expenses, 25 loyalties. No, you can't do that. Please give me a second. Zayama. All right. Hello, please, can you hear me? Am I audible?
Yes, sir, you're audible.
Yes, please.
All right. So please, that is it for the money measurement concept. That is it for the money measurement concept. And I hope we all understand, please.
I've understood this one.
All right, sure.
I've understood this one.
Let's move on to the next one.
Let's move on to the next one. Let's move on to the next one.
Yeah, hello.
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 Hi.
Hello.
Hello, I can hear you. Hello, is someone talking? Please, am I audible?
Please, you're audible.
Yes, sir.
All right,
Yes.
let's continue.
Yes.
Let's look at prudence or conservatism concept. Prudence or conservatism concept. Now, this one will at times bring about some disagreement. Some people will disagree. Okay, but please take note that they are assumptions. Okay, they are assumptions. Now, prudence concept is saying that don't overstate profit or assets. Okay, you should not overstate the value of your asset, or you should not overstate profit, but rather you should recognize or you should recognize what losses early, meaning that what anticipate what losses. Okay, simply we can say that don't overstate what your profit. Okay, don't overstate your profit, but rather overstate your losses or expenses. Okay, that is because it's an assumption when you are in doubt. Okay, now there is something about accounting is that there are doubts. Okay, but you should always be cautious. There is a doubt. Okay, but you should always what be cautious. Now you should not anticipate profit. Take note of that. You shouldn't anticipate profit. Even though the reason why you are doing the business is to make profit, but do not anticipate profit. But provide for what? All your losses. Meaning that what? When there is profits, don't overstate the value of your profits. And also, when there is an expense, don't understate it, overstate the value of your expense or your losses. Another way you can put it is that when you get an asset, don't overstate the value of an asset because some assets have this obsolete value, meaning that what they depreciate quickly. So don't overstate the value of an asset, okay, but rather understate it. Okay, do not anticipate profit, but rather provide for all losses. Okay, provide for losses. That is why in business, there's this thing that we always mention that you should make provision. You should make a provision. Put some money aside for losses. That is what we are talking about. So don't overstate your profit or your asset, but rather recognizes what profits. Sorry, rather recognizes what your losses. Meaning that what you should understate what your profits, but rather overstate what your expenses and your losses. Please, is that clear?
Yes, sir.
Very good.
Yes, please.
Yeah, I think you were
So
offline for a while.
Sir,
no, I wasn't offline.
sir, please can you repeat it?
Sir, your slide is not moving
Sir,
from my
please repeat
end,
it for
please.
us, okay?
All right, I'll repeat it. Please, is the slide moving?
Yes,
Can
it's
you see my
moving.
slide?
It's their
Yes,
networks. Yes, we can see it.
Then is the network. Was it?
Yes, we can see.
So this is what I'm saying. Okay. So let's say profit, and let's say assets. So the prudence or conservatism concept is saying that your profit and your asset, you should not overstate it. Okay. Understate it. Okay. Understate the value of your profit and your assets because of depreciation. Now, when it comes to your expenses and your losses, you should overstate them. This is that clear?
Yes, it's clear.
yes, please.
All right. So that's what we are saying. All right. So the next concept we are going to look at is the consistency concept. Consistency concept. Consistency concept. When we say consistency concept, now consistency concept is saying that in accounting, you have to be consistent, meaning that if you choose a method to use, stick to that method. Don't be changing methods. Okay. Now, most commonly we talk about depreciation. Okay, we talk about depreciation. What is depreciation? Who knows what depreciation is? What is depreciation? Have you done depreciation already?
Decrease in value.
Is it decrease?
Hello, have you
Depreciation
done depreciation already?
Sir, please, that consistency concept.
No, no, sir.
When there is when there is a value of
Yes, Grace, Madam Grace. What is depreciation? And have you done depreciation already?
Yes, please.
Sir, please, I didn't
Depreciation.
hear the consistency concept.
We are here to talk about consistency concepts.
Oh, okay. My
So,
phone went off.
Madam Grace, what is
Okay.
depreciation? And have you guys done depreciation already?
We are on depreciation, sir.
Oh, okay. You guys are on depreciation. All
Yes,
right.
sir.
So
Yeah, Madam Grace.
depreciation is when something like the value of something reduces. When
Okay.
something decreases in value, yes.
When something decreases in value. Very good. Very
Yeah.
good. Yes, Madam Mary. Yes, Madam Mary.
Depreciation value of a fixed asset
When there is what?
is the decrease in value of a fixed asset.
All right. Thank you very much. Madam Bernice. Madam Bernice. Madam Margaret. All right. So that is depreciation. Okay. When there is a decrease in the value, generally when there's a decrease in value of a fixed asset, that is what we term depreciation. Okay. That is why, let's say, some of you buy a phone for, let's say, 7K. Okay. You buy a phone for 7,000 cedis. You've used the phone for, let's say, 2 3 years, and most of you will not sell the phone for 7K again. You try to sell the phone for, let's say, 5K, or maybe based on the damage, you might sell it around maybe 4 5 or something lower than the 7K. But if you sell that phone above 7K, you're a criminal. You are a criminal. If you should sell that phone above that 7K, you're a criminal. I know there are some phone vendors among us over here. If that is your business, fine. But
sir, I mean, we want to make profits.
oh yes, you want to make profit, but you know that the value of that item, you know the
And then
value.
the buyer doesn't know that
So you
the value
tear
of
the
the
you,
item
you
has.
tear the you tear item for the buyer, right? You tear the
Yeah,
buyer's
yeah, I mean
item.
that one though. Yeah,
Hey
yeah.
Bozu. Hey Bozu. So class, his name is Emmanuel AJ. Why? Look at the name very well. If you want to buy from Emmanuel,
Yeah,
he will
it's
tear
not
your
me. It's
item.
not me.
Emmanuel will tear your item. Yo.
I will not
All
go. I
right.
will not go to his shop at all.
Silas, yes.
Sir. So I think you skipped the historical concept.
Oh, really?
Yeah, you did.
Oh, sorry. I'll
You
talk
only
about
spoke
it.
about the prudence and
Yeah, sorry. Thank you. We will talk about it. Since we are on consistency, let's finish it.
all right.
So let's say what consistency is saying is that depreciation, the way we calculate depreciation, we have about 4 methods of calculating depreciation. Yes, we have 4 methods of calculating depreciation. Okay. Now, if we choose one method, go with that method. We have 4 methods, but we commonly use 2 methods. Okay. We commonly use 2 methods. We mostly use the straight line method and the reducing balance method. These are the two common methods that we use. Now, as an accounting person or accountant, consistency is saying that you should stick to that one method. Don't start this with this method, then you come and continue with this method. No, don't forget, they will not give you, they will give you close values. Okay. If you use the reducing balance method, the value you get for that will not be the same, will not be exact as the reducing balance, even though the values will be close, but it will not give you the same value. Okay, so you need to stick. So consistency concept is saying that you used to stick with what? Using one method. Okay, you should stick with what? using only what? One method. Please, is that clear?
Yes, sir.
If you have stick to using one method, it means you are consistent. That is a consistency concept we are talking about. Now, historical cost concept is saying that assets and liabilities should be recorded at their original price, or sorry, at their original cost. Okay, assets and expenses should be recorded at their original cost. That is historical cost. Okay, so this is what this is saying. If let's say you buy a car for a business, you buy a car worth, let's say, 400,000 cedis. Okay, you buy a car worth 1,000 cedis for your business. Historical cost is saying that you should. So let's assume that this is the market price. Okay, they are selling the car for 400,000. So they are selling the car for 400,000. Then you bought it for, let's say, 350. Okay, you bought it for 350,000. This is the market value. This is the actual amount you bought it. So historical cost is saying that you should record this amount, the amount you bought it. Okay, this is the amount you bought the car. So you should record the value that you bought the amount, you bought the car, this value. That's historical cost. So so if you see the slides, they said assets and expenses should be shown at acquisition cost, not the current market value. Okay, record it at an acquisition cost. This is that clear?
Yes, sir.
All right. That is that for historical cost. Now let's look at periodicity concept. Periodicity concept. Periodicity. Now, periodicity concept is saying that the life of a business is divided into maybe artificial period. Okay, so every business, every business is a person. Okay, business is like a person, and the life of the business should or is divided in what in several periods. Okay, so most of the time, we mostly use one accounting year. That is 12 months period. Okay, so that is why you see a transaction. That is why you see a transaction. I'm coming. Let me see if I can show you something. Okay, let me write it rather. Let me open a sheet and we look at this. So let's say I'm sure that when you guys started solving questions on bank reconciliation statement and control account, you saw dates and all that, right? So now look at this. Let's say you saw these dates. First, you saw these dates. Let's say first. Okay, let me close this. All right. Now, when a business is on 1 year basis, okay, when a business is on 1 year basis, it is likely to start, let's say, 1st January. Okay, the business is likely to start 1st January and let's say 1st January of that year and end 31st December that year. Okay, this is one way of calculating 1 year of a business. Okay, now a business can be on 1 year basis and start, let's say, 1st July. Okay, business can start 1st July, let's say 2008. But we want to calculate 1 year for this business. This business started in the middle of the year. Okay, so another when you want to calculate 1 year for this business, it will be what? Let's say 30th June 2009. Please, you understand?
Yes, please.
Please,
Sir,
do you
not
understand what
clear.
I just did?
What of the
Please
30th
come
June?
again.
Sir, why not 1st
Please come
July
again.
2009? Sir, why not 1st July 2009?
Why not 1st July 2009? So, you
Exactly.
know,
Sir, why
okay,
not
so,
first July 2009?
okay, 30th, okay, so let's look at this. You started a business. You look at this. So, okay, why didn't you ask a question that, why won't we say that 1st January 2009? Why won't this business end 1st January 2009? Yes, the person who asked the question that why not
Sir,
1st June? Yes.
sir, because the person started in July, not January. So we
Okay,
assume that the next year will be in July, not January.
very good. Thank you for using the word assuming. Very good. So in accounting too, it is not like that. Okay, the way you will say think that okay, this year, let's say today is 18th, 18th. If you start a business today, which is 18th March, right? Today is 18th March. The next year, 18th March is 1 year. No, in accounting, it's not like that. Okay, in accounting, it's not like that. Because you started this year, you need to close this year to prepare your financial statements before starting another year. So it will end here and the other one will start here. So another business will start, another operation will start 1st January 2000. But this business is closing this year, which is 31st. Take note, this one is starting here and it is closing here so that 1st July it can start. Do you get the concept now, please?
No.
For me, I
Yes,
understood the first one, but the second one is confusing.
Okay, so this is it.
The second one, you made it 2020, 2009. What you are arguing is June 2009.
So
And
this
it's
is
correct.
it. This is it. Okay, look at this thing. This is 1st January 2008, right? This is 1st June 2008. 1st January 2008. And this is 31st July 2008. This is the ending of the year, right? So this is when the business is ending. So it will end here and another one will start 1st January 2009. Okay, so another one will be starting this date, but this is when this one is ending. Now, a business is starting 1st July 2008. It will end 30th June because June is 30 days. So it will end 30th June 2009. So that 1st July 2009, another one will start. Please, is it clear?
Oh, okay.
Sir, it's clear.
It means that it's clear.
Yes, it's clear. It's clear.
All right. So that is the 1 year basis. Okay. Some businesses too don't do 1 year, they do 6 months. Okay. So a business can start 1st January 2008 and close, let's say 30th June 2008. That is 6 months. Or another one will start 1st July 2008 and end 31st December 2008. That is also 1 year. So that is also 6 months. Okay, so it's either 1 year, 6 months, or maybe some people do it 3 months. Okay, so please, the periodicity is only talking about how businesses have been divided. The lifespan or the life of the business has been divided into several periods. That is all we are saying that periodicity concept. Please, is that clear?
Yes.
Hello,
Yes, sir.
is that clear, please?
Yes, sir.
All right.
Yes, sir.
So we move on to materiality concepts. Materiality concepts. So materiality concept
Sir,
is yes, please.
so to be able to write, you said periodicity concept. The life is the life of a business. What continuum for me to write because
The,
talk plenty, so
the
I
life of
couldn't
a
catch it.
business is divided into, let's say, artificial periods.
My network.
Okay. The
Sir,
life of
please
a
come again.
business,
My network. Oh.
the life of a business is divided into artificial time periods.
Thank you.
You're welcome. So materiality concepts. Now, materiality concept is saying that it's an assumption that you should only, treat trivial, sorry, you should only treat what? Important information. Okay. Trivial or insignificant items can be, treated as a whole. Okay. For example, let's say you are doing a transaction, then what materiality is saying that you should only record items that can be recorded in the financial statement. It means that for important items you should record them. Okay, things that are not important but have monetary value, you should put all of them together, meaning that, let's say, in the course of the business you bought books, exercise books. Okay, you bought exercise books, you bought pen, you bought pencils, you bought erasers and all that. In a preparation of financial statement, let's say the income statement, you cannot put all of them inside, or we'll be preparing the financial statement. You cannot say book 15 CDs, pen 10 CDs. No, you can't do that. What this is saying that you should put all of them together in a single name. You can call all of these ones stationery. I'm sure all of these things are stationery, right?
Yes.
Yes,
So
yes.
you can calculate everything and put it under stationery. Okay. Okay, so another one says that, let's say you pay transportation for one of your employee this month. You pay transportation, maybe you buy fuel, you do this, you do that. You cannot record all of them one after the other like that. So what you should do is that you should put everything together and name it your transportation. Then you record it. That is what the materiality is saying. I'm not saying that you should not record you shouldn't record everything, but only significant and important items, okay, should be recorded. But these ones, they are not really important. So put all of them together in one name and record. That is what the materiality concept is saying. Is that clear?
Yes, please.
All right. That is the materiality concept. So the next one is substance over
Sorry,
form.
kindly take the materiality concept one more time. Sorry for that.
All right. So materiality concept is saying that you should record important, only record important items. Trivial or insignificant items should be treated as one. Okay. Trivial or insignificant items should be put together as one. Okay. So items like maybe some expenses, you should only use one word and put all of them together. You can be writing them one after the other. That is what the materiality concept is saying. Okay. So I hope it's clear now.
Yes, please, sir. Thank you. Thank you, sir.
You're welcome. So substance over form. Substance over form concept is saying that you should focus on the economic reality. Okay. So materiality concept, yes, Faustina.
Yes, you explain one concept that says we should record items in monetary value. So what's the difference between that one and this materiality concept? I'm a bit confused now.
So the one that I say you should record the monetary value is the monetary concept. Yes, that is a monetary. That one is about you should record things that have monetary value. So assuming you are an employee, okay, Okay, you're a business owner. Are you going to record the loyalty of your businesses in the financial statement?
No, sir.
Are you going to record, let's say, your husband is in the business, or your boyfriend is in the business? Are you going to record the feelings you have for him or her in the financial statement?
No, sir.
Why? Why won't you record it?
Because they are not in. You can't value them in monetary terms.
Exactly. That is
It's not
why
physical.
that is not physical, it's spiritual. So that is what we are saying. Please, you understand now. But this one is talking about the materiality is that even though they have monetary value, okay, don't write them small like that. Put all of them together and write.
All right, sir. I understand now. Thank you very much.
You're welcome.
Sir, the other one.
Which is the other one?
After the materiality.
What is the name?
The substance over form concept.
And that is what we are here to explain.
Sorry, I
But
thought you've already
it
explained.
seems like you are in the future, or it seems like you are ahead of us.
Hello, sir.
Yes.
Good evening. Like, I wanted to ask that the materiality concept, can you say that they are transactions that you put them, irrelevant transactions that you put them at one account? You say it like that.
Yes, please. You can say it like that.
Okay. Okay. Okay.
You're welcome.
Sir, please, I
Hello,
can't see
sir.
screen anymore.
Yes, one
Honorable
at a
Edem.
Sir, I
time.
can't see.
Sir, please, what about miscellaneous and extras?
But miscellaneous is a word. So you can, there are some items under miscellaneous. So those items under miscellaneous, you cannot write them one after the other. You put all of them together as one total and call it miscellaneous.
Okay. Okay. Thank you.
You're welcome.
Honorable Edem, I also
Sir,
wanted to suggest that.
Okay.
Hello. I
Yes,
also
I can hear
wanted to
you.
say that with the materiality concept, you only record items that have monetary value, like items that are material. You don't record good services that are rendered to the business. Like if we're in the office and somebody comes and the person cleans your shoe, you will not record that one. But if a person presents something that you can quantify.
I'm coming. You are in the office and somebody come to claim your shoe.
Yes, that
But
is service rendering.
Your person claim your shoe or clean your shoe.
Clean, like clean. Use that.
Clean your shoe. Oh, okay.
Yes.
Okay. All right.
That one, the person has rendered a service and you won't record that one. But if the person comes to dash me something that can be quantified into monetary value, then it has to be recorded, if I'm right on that one.
Yes, that one too is right. Okay. But you cannot record the clean, the clean of the shoe, you cannot put it in the financial statement that cleaning of shoes, so and so. You put everything together as cleaning. Maybe there are people who come to clean the offices or the building. Anything under cleaning will go under that cleaning. Will go under cleaning. Not just necessarily the shoe. You cannot record that, okay, I've cleaned shoe for 15 cedis.
Okay. So services rendered that you pay them.
Exactly.
Right.
Exactly.
Okay. All right. Thank you.
You're welcome. Yes, any other thing?
Yes. Hello, sir.
Yes, madam.
Yeah. So, combining all those items under one particular section, I remember one of the topics we were told that some of the transactions go to the note. Is it
note to account?
Well, one of the yes. So are those things going to go to that section? I just wanted to find out.
Yes, please. They'll go to that section. Yeah.
All right. Thank you.
You're welcome. All right, let's move on to substance over form. So substance over form is saying that you should focus on the economic reality, that is the true substance of a transaction, not just the legal form of the transaction. Okay, focus on the economic nature of that transaction. So, for example, if you buy a sewing machine, let's say your business is sewing. Okay, your focus should be on the let's say um, how much is going to generate for you, rather than how much you bought it. Okay, your focus should be on that. Those who buy a car for Uber, taxi, or maybe service, they are, even though they know the amount they pay for the car, when they are working, their focusing is hitting the money they use to buy the car and making more. Okay, so the economic substance of a transaction should be reflected in the account rather than simply the legal form. So if let's say you buy a car, you recorded that, okay, you bought a car for this amount of money. How much the car is generating should also be recorded. Please, do you understand? Hello, do you? Okay, so you purchase, let's say, a sewing machine, okay, for the business. I'm sure you recorded you purchased a sewing machine, right?
Yes, sir.
Now, how much the sewing machine is giving you, the economic benefits the sewing machine is giving you have to record those things as well. That is the substance over the form, the substance of of whatever you purchase, the economic benefit. That is what we are talking about. This is that
Thank
clear?
you. Yes, sir.
You're welcome. So the last one we are going to talk about is duality concepts. Duality concept. So duality concept is saying that every transaction has what? Two sides, okay? Every transaction has what? Two sides. That is why every transaction, you record them in two books. So one transaction will go to another book of the debit, and one will go to the credit of another book. For example, let's look at this transaction. Let's say Kofi started business with 20,000 cedis cash. So this is just a normal transaction, okay? This is just a normal transaction. But this transaction is affecting two books, okay? This transaction is affecting what? Two books. The two books is affecting the cash account and what? The capital account. So the duality is saying that duality concept is basically that every transaction has for two sides, meaning they affect two books. Okay. So what we do is that what we are going to record in these two books. So capital will be credited in the name of what? Cash, 20,000. Then we come in. So since this is credited, this will be what? Debited in the name of cash. Sorry, in the name of what? Capital, 20,000. This is what this concept is talking about, duality concept. Every transaction has what? Two effects or aspects, the basis of the double entry system of bookkeeping. So what I just showed you here right now is what we call the double entry principle. You debit the receiver and credits the giver. Is that clear? Please, is that clear?
Sir,
Yes, sir.
please.
All right,
Sir,
sure.
sir.
So,
No,
yes.
please. It's again, I beg.
What is not clear?
The last one, the one you spoke about right now, please.
So, what he's saying is that every transaction is having two sides. Okay, meaning that it affects two books. Simple as that. Like every transaction. So, every transaction in accounting is having two sides. That is, it affects two books, meaning it will be debited in one book and be credited in another one. Okay.
Okay.
So let's look at the basis of accounting. So please, we are done with the concept, the assumptions. Okay. We are done with the concepts, accounting concepts. So some of you, in exam, you are likely to meet this one, the concept. So your lecturer can bring the concepts. Lecturer can bring let's say question 2. You can bring the concepts, then as A, then B will be control account question. Or A will be for you to solve control account question. Then B, your concept, explaining the concept. Let's look at the basis of accounting. So the basis of accounting, we have the cash basis and accrual basis. Revenues are recognized when cash is
Hello, sir.
received. Yes, please.
Yeah, so I wanted to find out maybe in exams when questions about the concept come and you are not able to give details of you are able to explain in your own words, but you don't bring the key words in there, like the explanation we just saw. Is it going to be marked for you?
It's going to be
Like,
marked. The accounting lecturer is a very descending person. Like he has this kind of good intention. If there is sense in nature, you get a mark. Is very good. The accounting lecturer is good. If you write and it is correct, it is explaining or talking about the right things, even though you are not using the keywords, but whatever you are saying makes sense, you get a mark. Dr. Sari is very good.
All right.
Yeah.
Thank you.
You're
Sir,
welcome. Yes.
sir, I also believe that sometimes the lecturers, they don't really look at what we copy from the slide direct. Like they want to know that we understand what we learned.
Exactly. That is simply Dr. Sari. Has he joined any of your face-to-face class?
No,
Yes,
me, I've
all the
not been
time.
to the face-to-face.
He always comes.
He always
We
come,
don't
right?
do face-to-face in my center.
Okay.
Please,
The Akala,
Brahima.
Brahima, very good. I'm sure he told you guys that people will fail, right?
yes, he did.
Oh yes, Dr. Asari Brahima will tell you that people will fail, but just make sure that you are not part of those people.
Yes, exactly.
Yes, yeah, and that is it. People will fail. Just make sure that you are not part of those that will fail. Simple as that. And he
He
will
said
tell
if
you
you
that.
fail, you become his friend. He said if you once
Yes.
you fail, you become his friend.
So Dr. Sari or Bray, he called me. He said Brahima. He's a very cool, easygoing person. If you deserve the mark, he'll give you. And one thing he normally does is that at times a student will get, let's say a student is supposed to get 50 marks, but Brahima will do it in a way that student will get like 60 or 70. That student will not get A, but that student believes so much in him or herself, thinking that whatever he wrote in the exam is better than the 70. So what he will do is that when you try to challenge, he will call you to his office, then remark it in front of you, then give you the mark you truly deserve. You get it? So for Brahima particularly, whatever you deserve is what you give you. If you deserve the A, he'll give it to you. That is if you write, if you understand and you write, even though maybe you're unable to write that well, but he sees that this person has actually studied, he'll give you the mark. He'll give you the mark. And it's a very good man, seriously. I've been in his class since level 200, level 300. He taught me taxation. This year too, he's still teaching me corporate reporting. So, like, he's someone that is very good. He's really, really good. Okay, so please, just take advantage of it. Has he given you guys the topic that will be coming in the exams?
In exam,
No,
he
not
gave us the
No.
only the IA.
Okay, so I don't know. Maybe this weekend or one of these weekends, he will give you guys the topics that will be coming. We'll give you guys the topics that will be coming.
study from
All right.
lecture 1 to 6.
And I'm talking about exams, not IA. Yeah.
Okay.
All right. So yeah, he'll give it to you guys. He'll give it to you. So let's look at the basis of accounting. The bases are cash basis and accrual basis. Okay. Don't forget, we've already explained the accrual concept already. So the understanding of the accrual concept is the same thing here. So the accrual concept is saying that what you should income and what expenses should be recognized or recorded when earned, not when cash is paid, right? Exactly here. So accrual is saying that revenue and expenses are recognized on an economic basis, regardless of the actual cash flow. So what it means is that you should know that you've made an expenses when the thing is being done, okay? Even though you've not made payment yet. And you too, you should know that you receive what? It may be revenue when you've done that service or you've provided the good, not when money is being received. Please mute your mic. Now, the cash basis is the opposite. So with this one, revenue are recognized when cash is what? Please mute your mic. So this one is you do not receive cash, but you should know that you receive cash. Okay. But this one is saying that revenues are recognized when cash is received and expenses are recognized when cash is paid. So with the cash basis, when you make payment before, you know that what you receive what revenue. But with this one, even though you've not received revenue, even if you provided the goods or the services, you should know that you receive cash or receive revenue, even though you've not received money yet. Okay, so this one is about cash and carry. Okay, and this one is about let's say maybe the thing has been given before you come and pay. So this one is the assumption that, or the basis is that you know that you receive income even though you've not received the money yet. But so far as the product or the service have been rendered, you know that you receive money. But this one, yeah, the cash basis is about cash is paid before service or product delivery. This is that clear?
Yes, sir. Yes, please.
All right, so that is it. That is it for.
Hello, sir.
Yes, please.
So, is it right if I say that any amount accrued will go to the debit side?
Accrued. What justification do you have that any amount accrued will go to debit side, please?
I asked with regards to the explanation you gave. Maybe I didn't get the right understanding.
So if you're talking in terms of cash book, this is the receipt aspect and this is the payment aspect. So if you are receiving money, rather it should be debited. If you are paying or money is leaving you, it should be credited. So expenses are accrued to be what? To be credited. Yes.
Okay.
The basis of accounting, cash basis and accrual basis. Now, I didn't hear the
explanation. My network messed up.
Do you understand the accrual concept?
Yes, sir.
What is accrual concept?
What concept in clear way? I've written it somewhere.
What is accrual concept?
Hello.
Hey,
Yeah, hello.
I know, but I can't find.
Hello.
It's
you
accrual concept. Please let me explain my thing. The accrual concept is record income when earned and record expenses when they are incurred, not actually in cash. That was what I heard.
So do you understand what you just read? Do you understand? And I'm
The
glad
network is messing. Say I didn't hear.
Do you understand what you just read?
Yes.
So what does it mean?
Should I explain it in
Yes.
a normal thing?
Yes.
Yes.
Please.
You are saying that when I buy something, when when I make profit, I should record it, and then when I make expenses too, I should record it. Not necessarily in cash.
That is what you want. Not necessarily what?
In cash, or not only when it is cash. When cash is involved, am I? So you are laughing at me.
All right.
You people, when we were doing your face to face, I wasn't there. You leave me.
Okay, so Madam Gladys, this is what we are saying. Okay, so the accrual basis is that when you sell to someone, okay, when you sell to someone, you should record that what you've made sales or you've made revenue, even if the person did not give you the money yet. So far as you've rendered a service or you give the person the goods, you should record that what you've made money.
Oh,
okay.
Yes.
Now, if you are going to buy something from someone, even though you've not paid the person yet, so far as you've received the good or the service has been rendered to you, know that you've made an expense. Do you understand?
Yes, sir.
That is that is the accrual basis. Now, the cash basis is the opposite, that before you even receive the good or the service, you have to pay first.
Okay.
So simple as that.
Thank you.
You're welcome.
Accrual after, cash before.
No, accrual is before cash. The thing is being received before cash. So you can say accrual is before cash, then cash is before.
After.
Okay. After, okay. Yeah. Just understand them. If you understand, everything else will follow. Okay. So that is that. That is it. That is that. So we are expected to do section 3 as well. But my energy is coming down, so we will meet tomorrow. Okay. Thank you for joining tonight's session. See you guys.
Yeah, you say your lady.
Thank you.
Is that?
Thank you.
His energy is down.
God bless
Madam.
you.
Yes,
Honorable
please.
Adam, please, you said
Madam,
we are supposed to finish lecture 3, but something, we didn't hear
Yes.
that thing.
My energy is down. Like
His energy is down.
I'm tired. Yeah.
Yes.
fine.
I thought you said your lady is down.
My lady.
Sir, we heard your lady is
Tomorrow,
down.
Yes. And I
Sir,
also
we
heard
heard
my
your
lady.
lady
please.
is here.
The question
Your
here by
lady has
some.
come.
Asking.
Hey,
Yes, Adam.
you people.
So then, please, the questions we are talking about, the I questions, the trial questions you said we
Yes.
are talking about. I don't have them.
Yeah, we are supposed to solve them. We will solve them.
But I don't even have the
have
questions
them.
before we solve them. Yes.
Please, it's on the
page.
collective page. It's on the collective page. So if you are not there,
Collective
you
page.
should be on that page. Yes.
It's on the
Right
page.
mind
There's no collective page. What
Right
is
mind
collective page?
collective.
Sadam.
Hello.
Please, can someone help me get it?
It's called Bright Minds Collective Page. The questions are
Okay,
there.
Bright Minds. Okay.
Yeah, so where
Hey,
you
then
clicked
I'm
on
not
the
there.
link, please let me finish. Where you clicked on the link to join this class, the WhatsApp link is attached to it down there. So just click on that and then to take you to the page.
Is this my friend Helen?
No, please.
Oh, okay.
It's Regina.
All right. Thank you for joining. Have a good night. Bye-bye.
Sadam.
Bye.
Yes, please.
God bless you.
After the hour, you have to find time and meet us face to face for these calculations. It's not easy. It's confusing. You beg you.
Then,
After the hour,
then you have to come to Sunyani too.
you have to try and meet us.
We also need you.
Before the lesson. Yes.
Sunyani people need you too.
This calculation.
I will pay. I'll even accommodate him. I'll even accommodate him.
Mr. Please, is it our financial?
Your network is no good.
Please, I can't hear
Your
you.
network is no good.
Honorable
Your network is no good.
Please, is it Honorable Atufo as is it Honorable Atufo in a financial secretary for JCR?
No, please.
Atufo in the hand, you are buying Munana. Is it the one in
please, it's
Parliament?
not
Which Atufo?
Then I will beg you after the hour, you have to organize us again, please.
I heard someone say we will bribe you. Are we doing bribery and corruption here? Who is saying we will bribe you?
This accounting the Jerry.
Did you say you will bribe, say?
What is wrong? Why are you so keen about the bribe something?
Nobody talk about bribe here. Who talk about bribe here?
Concept of what is a forehead.
And you all support bribery and corruption. You people, you not make it to heaven.
Who talk about bribe here?
And the man ye mfanchami. Man can ye cry.
I said we beg him like you should after the IA should try and organize us face to face again. That's what I said.
Fry yourself small. The way you are talking, it sounds like you are saying we bribe you.
I didn't say any bribe.
Then
I said
fry
after
yourself.
the IA.
When you are
should try
talking,
and meet us.
fry yourself. Say has left too. And I'm a boy.
I'm here.
Hey, Afra.
Please, are we done?
Hey, will you come to Sunyani?
Will you send flights to come and pick me?
Hey, wo.
Yes, we are done.
Hey, sir, after the plane crash, the helicopter crash, you still want to board flights?
But there are so many accidents happen in the country.